Investing in US stocks through mutual funds made easy. Hey everyone, welcome back to Everyday Elevate, your go-to channel for financial wisdom and smart investing strategies. Today we're diving into an exciting topic that's been gaining a lot of traction: how to invest in US stocks through mutual funds, specifically for our Indian investors. Why are we talking about this? Well, Indian investors are increasingly looking at international markets to maximize their returns. Take a look at the S&P 500, which has surged by over 200% in the past decade, compared to the S&P BSE Sensex, which nearly doubled in the same period. The primary Wall Street indices, including the Dow Jones, Nasdaq, and the S&P 500, have doubled investor returns in just the last 5 years. Mutual funds are a fantastic way to approach this, especially for long-term investments. They offer higher returns than direct equities, and the added benefit of diversification. So whether you're seeking attractive returns or aiming to diversify your portfolio, international mutual funds could be your answer. Stick around as we break down the best ways to invest in US stocks via mutual funds, key points to note, who should consider these investments, the associated risks, and the tax implications. Let's get started. Call to action. Before anything else, smart investors, if you're eager to explore new opportunities and grow your wealth through international markets, make sure to smash that like button and leave a comment below. Your engagement fuels our mission to provide valuable insights and strategies for financial success. Let's go through this journey together and elevate our investment strategies. Options for Indian mutual fund investors to invest in US stocks. At present, Indian mutual fund investors find themselves with a solitary route to tap into the vast landscape of US stocks. This avenue manifests through the selection of US-focused international mutual funds, serving as the conduit through which individuals can direct their investments towards American equities. These funds predominantly consist of overseas fund of funds, FOFE, or other international mutual funds meticulously curated to capture opportunities across global markets. An international mutual fund, in essence, functions as a financial vehicle strategically positioned to invest primarily in equity or equity-related instruments listed on foreign market exchanges. Moreover, it often diversifies its investment spectrum by allocating a proportion of its portfolio towards debt securities, thereby offering investors a balanced approach to international market exposure. Key considerations regarding US-focused international mutual funds. For prospective investors, it's crucial to acknowledge that US-focused international mutual funds present a valuable avenue for diversification within their investment portfolios. Diversification is a fundamental principle in investing, aimed at spreading risk across different asset classes and geographic regions. By incorporating international assets, such as US stocks, investors can potentially enhance their portfolio's returns while mitigating the impact of market volatility and economic downturns that may affect domestic investments. Moreover, currency fluctuations can also impact the returns of US-focused international mutual funds. Exchange rate movements between the Indian rupee and the US dollar can influence the value of investments denominated in US dollars, thereby affecting the overall performance of the mutual fund. Consequently, investors need to consider currency risk as an integral aspect of their investment strategy when venturing into international markets. To navigate these complexities effectively, investors are encouraged to conduct thorough research, seek guidance from financial advisors with expertise in international markets, and adopt a prudent approach to portfolio diversification. By staying informed and diversifying intelligently across global markets, investors can potentially capitalize on opportunities while managing the associated risks, thereby optimizing their long-term investment outcomes. Who might find international mutual funds suitable for their investment needs? Investors considering expanding their investment portfolio into the global market, particularly focusing on the US, may find international mutual funds to be a viable option. However, it's worth noting that these funds are particularly well-suited for individuals with specific investment objectives, which include facilitating geographical diversification to mitigate overall equity portfolio risk, establishing a hedge against rupee depreciation, augmenting domestic equity exposure with investments in foreign economies. As per the analysis of certain experts, American corporations like Netflix, Amazon, Facebook, and Microsoft are perceived to be strongly positioned to navigate through potential disruptions in the global economy. Nonetheless, it's crucial to acknowledge that no investment comes without risks. A slowdown in the technology sector in the US, for instance, could adversely affect investments in these prominent stocks. International mutual funds typically attract investors who espouse a long-term investment horizon and demonstrate a willingness to embrace higher levels of risk in pursuit of potential rewards. These funds offer a gateway to diverse opportunities across global markets, allowing investors to participate in the growth potential of economies beyond their domestic borders. By incorporating international assets into their portfolios, investors can benefit from broader market exposure, enhanced diversification, and the potential for higher returns over the long term. What are the potential pitfalls associated with investing in international mutual funds? Investing in these mutual funds carries a handful of minimal risks. Foreign market risk. International mutual funds expose their investors to a range of risks stemming from the economic, political, and market conditions of foreign economies. These risks might be elevated, particularly in certain emerging markets, owing to factors such as limited liquidity and regulatory frameworks. Exchange rate risk. Changes in foreign exchange rates are susceptible to fluctuations, which can consequently exert a negative influence on investment returns. Concentration risk. An international mutual fund that maintains a concentrated investment portfolio may potentially impact returns during sector-specific downturns. This strategy carries heightened risk, resulting in increased fluctuations in returns. What tax considerations are associated with international mutual funds? Taxation on international mutual funds in India follows the same principles as taxation on other types of mutual funds. Long-term capital gains, LTCGs, on the redemption of units after holding them for more than 3 years are subject to taxation at a rate of 20%, with the option to avail indexation benefits. Short-term capital gains, STCGs, on mutual fund units redeemed within 3 years of investment are taxed based on the investor's applicable income tax slab. Dividends exceeding Rs. $5,000 are taxed according to the investor's applicable income tax slab. Typically, resident investors face a tax deducted at source, TDS rate of 10%, currently at 7.5%, while non-resident investors are subject to a TDS rate of 20%. This video guide on investing in U.S. stocks through mutual funds tailored for Indian investors emphasizes the growing interest in international markets for maximizing returns. It highlights the benefits of mutual funds for long-term investments, such as higher returns and diversification. Key points covered include investment options. The primary route for Indian investors to access U.S. stocks is through U.S.-focused international mutual funds, which are predominantly overseas FOFs or other international mutual funds. Benefits and risks. While these funds offer diversification and potential high returns, they also come with risks such as exposure to foreign market fluctuations, exchange rate risk, and concentration risk. Suitable investors. International mutual funds are recommended for investors seeking geographical diversification, hedging against rupee depreciation, or supplementing domestic equity exposure with foreign economies. They are best suited for individuals with a long-term investment horizon and higher risk appetite. Tax implications. Taxation on international mutual funds in India follows the same rules as other mutual funds, with long-term capital gains taxed at 20% with indexation benefits, and short-term capital gains taxed according to the investor's tax slab. Dividends above Rs. 5,000 are taxed based on the investor's tax slab, with resident investors subject to TDS at 10%, currently 7.5%, and non-resident investors at 20%. Overall, while investing in U.S. stocks through mutual funds can offer attractive opportunities, investors should be aware of the associated risks and tax implications and consider their investment objectives and risk tolerance carefully. That concludes our video. Don't miss out on our future contents packed with valuable insights and smart investing strategies. Hit the subscribe button now and join our community of smart investors. Also, remember to turn on notifications so you never miss an update. Let's grow our wealth together with Everyday Elevate.